Hello friends, Chris Lee, CPA here, back with another video for you. And today we're going to talk about some, tax year end 2025 strategies for your stock portfolio. So when it comes to thinking about tax planning for a stock portfolio, the first thing we have to realize is that most often you're talking about capital gains and losses. And so we first have to understand some elements of capital gains and losses, how they work, and all those sorts of things before we can start, implementing some strategies around that. So the first thing to think about when it comes to capital losses and to know is that there are two buckets. There are short-term and there are long-term. So short-term gains and losses are, 1 year holding period of that stock before you sold it. And then long-term is if you held the stock for more than a year and you sell it, they get taxed differently. So short-term gains and losses, that 1 year bucket, is going to be taxed at ordinary income tax rates. And so the consequence there is that you have the potential of up to that 37% tax bracket. And on top of that, there's the net investment income tax, which is 3.8%. So when you tack the two together, you could end up with a tax rate up to 40.8%. So short-term gains have a very high potential tax associated with them, and that doesn't account for also the state income tax consequences. Now, in contrast to that, we've got long-term capital gains, which can be taxed at a 0% rate up to a 20% long-term rate in general. And again, that 3.8% could be added on. So we're looking at 0% to 23.8%. When you combine the long-term capital gain rate plus the net investment income tax. So we're comparing a 40.8% tax rate to a 23.8% tax rate. So that's when we compare the short-term bucket to the long-term bucket. And as I noted, like these are, the highest potential tax rates. How they apply to you could be different. So because there's thresholds and all sorts of amounts that apply. But just most importantly, we need to know there are two buckets, the short term and the long term. Short term, less favorable, long term, favorable. And then within that, we need to know that the gains and losses within those buckets, the long term bucket offset those gains and losses first. And then within the short term bucket, we offset gains and losses, and then we can, offset between the two buckets in total. But yeah, we just need to know that there's a netting process that goes between when we've got some gains and losses in one spot, some gains and losses in another spot, and the mechanisms that go forward from there. And they can yield some surprising results. Similar to long-term capital gains rates, the qualified dividends, which are generally stock, dividends from stock from U.S. corporations, those are also taxed at the long-term cap gain rate. So that means it could be a 0% tax rate up to a 23.8% tax rate, depending on your income level. Now, when it comes to at the end of the year, when you've got a net capital loss between, you do the mechanisms in the netting process between the short-term bucket and the long-term bucket. The tax code limits the amount of excess losses you can use. So if you end up with a net capital loss, the max you can use is $3,000. So say you had you have total net capital loss for the year, $10,000. You can only use $3,000 of it, and then the remainder $7,000 is going to carry forward. So only $3,000 of your net capital losses can be utilized to offset ordinary income. So that could be, interest income, retirement minimum distributions, wages, all those sorts of things. Next, you need to think about the fact that when you donate stocks, so if you're going to end up being charitably minded with your investment portfolio, that it is donated at fair market value. So that means you can donate assets that are appreciated and, potentially forego any built-in capital gains that might be on that stock. But also, if you were to donate depreciated stock, that you lose out on that capital loss. You're basically transferring it to the organization, the receiving charitable organization. So with those concepts in mind, that's how we kind of go with the framework for the remaining portion of the discussion. So strategy one is properly offsetting gains with losses. And so oftentimes you'll hear this called tax loss harvesting. If you are working with a financial advisor, usually they're going to be doing tax loss harvesting in your portfolio. But the big issue that I often see is if you have part of your portfolio with a financial advisor and you have a self-managed portion, you might be finding that only the advisor portion has properly utilized tax loss harvesting rules and the self-managed portion is not. And so you might end up with surprising consequences there. So you really need to be, if you're going to choose to self-manage your portfolio, you need to be conscientious of how that loss harvesting is working across your portfolios, because all of that in the end is going to be aggregated on your tax return. So just be mindful of what you need as an outcome to, maybe trigger some long-term losses to offset some short-term gains in the aggregate, so that you can, avoid higher amounts of short-term capital gain. So the next thing is that if you're going to have excess losses in the year, we want to properly utilize long-term losses. So the long-term losses, right? We talked about those being subject to a tax rate of 0% to 23.8%. Well, remember when I said excess losses can be used to offset your ordinary income, right? Those are the income that fall into those normal brackets. So when we, if we're going to end up with excess losses, we might as well use the long-term bucket, because they have favorable tax rates for gains, but if they're going to have losses, they actually could be utilized against higher tax rates. And that's where the benefit is you can get a rate differential. Where you might otherwise be taxed at, a 15% tax rate, for a gain, you could use that excess $3,000 loss to, have fundamentally what is a deduction at a 24% tax rate. So if you're going to have excess losses that you're going to use that $3,000 rule, it's preferable to use long-term losses. They end up better for you. So the third strategy is making sure you don't trigger what's called the wash sale rule. So if you're an individual investor and you're working with stock and securities, there's a rule that says basically if you sell your stock and that stock is going to be, and you repurchase that same stock or what is similarly identical stock within 30 days of the sale, that if you triggered a loss on that previous stock, you don't get to recognize the loss on the sale. So again, you sell stock or some other security and then purchase substantially identical stocks or securities within 30 days before or after that date of sale, you aren't going to recognize your loss on that sale. So that's one thing to actually think about too, is that it's not only purchasing the stock 30 days after you sell it, it's actually within 30 days before or after you sell that lost stock to trigger that loss. That's how the wash sale rules. So you actually have kind of a more extended window than you would realize where the wash sale rule could be triggered. So if you're wanting to trigger a loss in 2025, then you'll have to sell the stock and be sure to not repurchase that same stock or substantially identical stock within 30 days of that transaction. So when we say substantially identical, the concept here is that if you had maybe a Vanguard S&P 500 ETF, you sell it, and then within 30 days, if you were to purchase like the Fidelity S&P 500 ETF, those are substantially identical, right? So while I will say that I have never seen a brokerage be able to track in such detail that sort of level of substantially identical stock. Technically, if that was audited transaction for whatever reason, it could be found that, even though your 1099 said one thing, that in full application of the tax law that wasn't substantially the correct answer. And so just be mindful that if you're going to be doing that, what substantially identical would and could mean. So the next thing is to make use of the lower tax bracket. So if you're going to give money to maybe a family member to assist them with some living expenses, retirement, whatever, thinking of gifting to your family, be sure to consider it, and you're going to be maybe liquidating some of your stock portfolio. A couple of things you want to think about. So first, if it's going to be appreciated stock, you'll want to make sure that you're in like a higher tax bracket. Rather than liquidating the stock, trading that gain on your tax return, it's better to actually go ahead and gift the stock to them. And when you gift the stock to them, have them liquidate it, have that sale transaction to trigger the gain. And because of the way the tax brackets work and them being a lower tax bracket, they can end up putting that gain on their lower tax bracket tax return. So for example, like say your parents have less than $100,000, you're going to be supplementing them and you'd be liquidating part of your stock transaction. So if they're around like $97,000, capital gains and losses for them, long-term particularly, are going to be at a 0% tax rate. But maybe on your tax return, it'd be at a 23.8% tax rate. If you're transferring those funds over to your parents, through liquidated stock, rather than liquidate the stock on your tax return, trigger that gain, and send them the cash, transfer the appreciated stock and let them trigger the gain where they're in a 0% tax bracket. So that's fundamentally what we're thinking about when we're thinking of using lower tax brackets if possible. One thing to think about is if you're gifting stock to children, you need to be aware that there are certain rules called the kiddie tax. I'm not going to go into it here, but basically it can say that if you have stock that is, you can't basically use your children to shift gains into favorable tax brackets in certain circumstances. So maybe I'll do a video later on about the kiddie tax, but just know that children transferring stock and gains to children can be a little bit more complicated than, say someone else, like parents or something. So the next strategy is going to be donating appreciated stock to charity. So if you're going to donate to charity, consider, appreciated stock. And the reason being is because when you transfer stock to a charity, you don't trigger a capital gain or loss on your tax return. You don't trigger an event. What you are doing, though, is you get a charitable deduction donation if you itemize your deductions at the fair market value. So say you've got stock, you paid $10,000 for it, it's now worth $20,000. You can, rather than liquidate it for $20,000, have a $10,000 gain on your tax return, you can say, okay, charity, here's $20,000 of appreciated stock, and get a deduction for $20,000, but you never recognize that gain of $10,000. It just goes away. So the big benefit is, as noted, is you get to deduct the fair market value of the stock as a charitable donation. You don't pay any taxes that you would have paid if you would have sold the stock. And so a couple things to think about here is with donating stock to charitable organizations, it's limited to 30% of your adjusted gross income. So if you're going to exceed that amount, it's not that the deduction goes away, it just becomes a carry forward for the excess until it's used up, and you have 5 years to use it up. So, and remember that charitable donations only really benefit you if you're going to be itemizing. We will see a return of the non-itemized charitable deduction, but those are required to be cash contributions. So the strategy is not going to work for that. So that'll be tax year 2026, but as of right now, that's not in effect. The last strategy is make sure you don't donate stock that has losses to charities. So say you've got stock that's $15,000 purchase price, it's now worth $10,000, and you're going to do a $10,000 donation to charity. Be sure you don't just send them the $10,000 stock rather than cash. You actually want to go ahead and trigger that loss, right? Because then you can get that $5,000 loss on your tax return, and then you can take that cash of $10,000 and send it over. So the opposite thing of sending appreciated assets rather than cash. So if we have appreciated assets, we want to send that directly to the charity. If we have depreciated assets, I say that to mean that the fair market value is less than the purchase price, we want to make sure that we actually liquidate that asset for ourselves, trigger that loss on our tax return, and then send the proceeds over. So imagine you've got that $15,000 stock purchase price, you sell it for $10,000, you can potentially use that $5,000 to offset other gains, or you can use the excess, if it triggers excess losses, you can use some of that to offset your ordinary income. And so that's the big benefit there. So that kind of covers our key strategies. 1, tax loss harvesting. 2, making sure that if we're going to have excess losses, that they're coming from a long-term asset to be efficient. Avoid the wash sale rules. Be sure to make use of lower tax brackets if we're going to be, between family members or people that we support. 5 is donating appreciated stock to charity, and number 6 is making sure we don't donate stock losses to charity. So those are the key factors we need to think about. But yeah, absolutely, there are some opportunities here. And if you do work with a financial advisor and then also self-manage some investments, it's really important that you do get a little educated on these items, just so you can be efficient across your whole portfolio. Which minimizes lifetime taxes. So if you have any specific consults that you want to, touch base on, or, if you think you'd want to work directly with me on any, decisions or tax return preparation or anything like that, you can use the link in the video description to book a call. So I'll be back soon with another video. Take care. Bye-bye.